Well, the latest numbers are now in, and the U.S. inflation rate has risen now for the third straight month. We're going to look at that in some detail today. Inflation hit 2.9% in December. That is up from 2.7% last November. So I want to take a look here at what is behind this increase, and let's start with the basics here. The U.S. CPI, which is the measure of overall price changes in the economy, rose by 0.4% in December on a monthly basis. That is the biggest jump since March last year, and it came in slightly above market expectations, which were 0.3%. Now, on a yearly basis, and this is what we kind of hear most of the time, inflation increased to 2.9%. And that's driven by a mix of factors: energy, food, transportation being some of the biggest. We're going to look at some of those more in detail in just a moment here. Now, meanwhile, the core inflation rate, so this excludes food and energy, the more volatile sectors, it was down slightly, came in at 3.2%. So the good news here is that core inflation is showing signs of easing. The bad news, though, is the headline inflation that's being taken up by some pretty sticky categories that affect our everyday costs. For a detailed breakdown, let's look at some of these by category because not all of the prices across the board are rising or falling equally. We look at energy costs first. They saw a smaller decline in December compared to earlier in the year. Year over year, energy prices dropped by just 0.5%, and that's a far cry from November's decline, which was 3.2%. Gasoline prices, they were down 3.4% over the past year, but in December alone, they were up 4.4%. That makes them a key driver of the monthly increase in the consumer price index this time around. On natural gas, that was up by 2.4% in December. That contributes to an annual increase of 4.9%. Even electricity prices inched up 0.3% last month. Now, energy alone, this accounts for over 40% of December's monthly CPI rise. So that sort of highlights how volatile and impactful this category is. I want to move now to food prices. They continue to rise. They're up 2.5% year over year, and eating out isn't getting any cheaper either. Restaurant prices increased 3.6% over the past year. With limited service meals, so think fast food, they rose by 3.7%. Another key cost that we all have to deal with is shelter. And shelter inflation, it slowed slightly to 4.6%. That's the smallest increase since early 2022. So that's good. But this category still has a big impact on the overall inflation number. It accounts for over 2/3 of the core inflation increase. Another notable category was transportation services. They jumped by 7.3%, and that was mainly due to higher costs for airfares and motor vehicle insurance. So let's take a look at the impact that this has on both policies and on the markets. I want to start, first of all, the mixed message that this is sending to both policymakers and businesses. When I look at it from the perspective of the Federal Reserve, this uptick in headline inflation, at least, it does complicate their decision making when they come up to their next decisions on rates. On one hand, we got core inflation that's cooling, that supports a pause or even a modest cut in inflation rates. But then on the other hand, you've got energy prices, you've got these persistent costs in housing and transportation that could give the Fed some pause for holding things where they are now. When you look at it from the perspective of the markets, they are also having to work through a lot of uncertainty here. When I focus in on the energy sensitive sectors, I think transportation, we feel that pressure of the higher gasoline prices. And when you look at industries that are tied to consumer spending as well, retail, hospitality, you might find some relief in the slowing shelter costs that at least modestly ease core inflation. For businesses, you've got higher transportation costs, higher insurance costs, and these definitely will squeeze margins. And from a consumer side, you're likely to feel some increases to your everyday spending. Now, looking ahead, all eyes are still on energy prices. If gasoline, if natural gas, if these prices stabilize, we could see inflation start to retreat in 2025. That would be a good thing. But if these global tensions flare up, or severe weather like we're seeing lately, if that impacts or disrupts the supply chains, then energy costs could spike again, and that would definitely throw a wrench into the Fed's plans. They're going to want to avoid overcorrecting. So the bottom line, this year, it was not going to be boring. We're going to have an interesting 2025. I would love to hear your perspective. You can share your thoughts in the comments below. Now, I want to move on now to the business and unions forming the Trade Council here in Canada. And businesses and unions across the country are joining forces to create the Canada-U.S. Trade Council, CUSTC. And this is in response to the threats from the incoming Trump administration. This council is planning to work with Ottawa, provincial governments, and it's going to focus on the potential fallout from the proposed 25% tariffs on Canadian goods. Now, as we've probably heard, I'm sure we have, Trump has taken a very, very hard stance on Canada, accusing it of contributing to illegal migration, to drug smuggling, and he's also raised this specter of Canada being the U.S.'s 51st state. I'm not sure how much attention most people are giving that attention, maybe, but how serious this, I'm not sure. Now, Trump's administration, they seem to be, from what I've seen recently, preoccupied with what he's calling a $100 billion trade deficit with Canada. Now, that's largely driven by oil, gas imports, and he also plans to renegotiate the USMCA trade deal when that comes up for negotiation in 2026. Now, the CUSTC, where we started this story here, this includes representatives from major sectors, think steel, aluminum, banking, agriculture. The Aluminum Association of Canada and the Canadian Steel Producers Association are leading this steering committee. And the council clarified it isn't designed to be a lobbying group, but it's going to be serving as a platform for sharing information, strategies, and it's going to be holding regular meetings with government officials. Now, Lana Payne, she is the national president for Unifor. She puts everything here into perspective. I'll tell you what she said. She says, given the very seriousness of this moment and the existential threat to Canadian jobs and our economy, we see it's important for Canadians to pull together and work together during these difficult times. We must put workers and the country first. I want to move on now to a story by David Rosenberg over the last couple of days, talking about some warnings he has about the U.S. stock market and how overvalued that is here. But before I go there, I did want to say that your financial future is obviously important. It's too valuable just to leave to chance. And that is why my son Brandon, he started the Investing Academy. This is a company that is dedicated to helping Canadians take control of their investments and to build lasting financial security. Now, Brandon got to start in investing way back when he was 10 years old. And yes, you did hear that correctly. He was an early starter there. He then started working at my firm when he was just 20. As for me, I spent over 25 years as an investment advisor, portfolio manager. I retired, but that didn't last very long. After that, Brandon had asked me to join him in this mission he set out on to educate Canadians about the stock market, and I just couldn't resist the chance to share what I had learned with a whole new generation of investors. Well, to date now, we've helped over 2,000 beginner investors through the Investing Academy. This is an online program that's designed to make long-term investing simple and accessible. Whether you are just getting started or whether you're looking to build on what you already know, we are here to guide you. You can learn more by visiting our website. I will put a link in the description of this video. Now, David Rosenberg, he is a veteran economist here in Canada, and he is warning the U.S. Equity valuations are just too high right now and pose significant risks for investors. He spoke with BNN Bloomberg, and he described the market's current state as a twice-in-a-lifetime event of overvaluation. Points to the S&P 500 price-to-earnings multiple at its highest levels now since 1929, 1999, and late 2021. And here's something he said that really sort of summarizes his thoughts. He says, we have a situation where the multiple in the S&P 500 is now a 2.3 standard deviation event, and we've only been this expensive on the S&P 500 in 1929, in 1999, and we were there briefly back in late 2021. Both foreshadowed pretty rough years for the market that nobody saw coming, because the tendency for investors, well, for everybody, is to always extrapolate the most recent experience into the future. He notes also that the market assumes an unrealistic 20% annual growth rate right now for the S&P 500 over the next 5 years, and that is far, far above the historical average. In his talk, he commented that if you believe that AI is going to drive productivity that much higher and business costs that much lower, that we're going to get 20% earnings growth in the next 5 years, then I would suggest this market is for you, not for me. Maybe it is for you. Valuations are just too high for my liking. Another thing that I noticed about his talk is he flagged the concentration risks. And he says right now the U.S. households are allocating over 70% of their financial asset in equities, and 60% of these are in passive index funds. And he compared this to the late 1990s tech bubble. He cautions that there's too much concentration and that increases systemic risks. So he has this bearish outlook on the U.S. stocks in particular. But that said, he does favor Canadian equities for what he says are compelling valuations and strong dividend yields. He says that the valuations in Canada are actually compelling, both absolute and relative. He does also see value in U.S. bonds. He specifically talks about the 5-year Treasury curve, and he suggests that it does offer a favorable entry point. That will be a wrap for today's video. As always, I hope you enjoyed. Thank you so much for watching. We'll see you in the next video.